evening, or good day wherever you are. I want to talk to you about something that's rippling through the financial world right now, something that matters deeply. If you own gold or silver or plan, the recent actions coming out of the Federal Reserve are sending signals that will reverberate through markets for months, even years. And whether you are cautious, optimistic, or somewhere in between, you need to understand what's happening so you can act wisely. The Federal Reserve is at the center of how the system works, and understanding its decisions is essential to understanding where wealth is going to flow. When you step back and look at history, see the same cycle, repeat periods of credit expansion followed by tightening, followed by some kind of adjustment in the value of money and assets. What the Fed does is not random. It is a response to pressures in the economy, and those responses carry consequences across every market, including gold and silver. Right now, the Fed faces a dilemma that is both classic and dangerous. On one hand, inflation has been stubborn. Prices of goods and services have risen in ways that undermine purchasing power. On the other hand, the economy shows fragility. Debt levels are historically high, and raising interest rates aggressively risks making that debt unserviceable. That trade-off is at the heart of every decision they make. If they prioritize controlling inflation, they tighten policy, raise interest rates, and attempt to withdraw liquidity from the system. That tends to strengthen the dollar in the short run, but it also risks weakening growth and raising the probability of a downturn. When policy is too tight, markets begin to break. You see stress in credit markets, pressure on weaker institutions, and widening spreads. At those moments, the Fed tends to reverse course, eases again, lowers rates, or injects liquidity. The problem is that these back and forth swings create long-term instability. Each cycle leaves behind more debt and more dependency on low rates. Over decades, that dynamic weakens the currency itself. Money is being created at a faster pace than real productivity. Productivity, that's where gold and silver come in. They are not dependent on the Fed's promises. They are not someone else's liability. When trust in money or policy wavers, investors look for stores of value outside the financial system. Every time the Fed chooses more easing or allows real yields to go negative, it effectively supports the case for owning these metals. When they tighten aggressively, metals often struggle in the short term, but that struggle is often temporary because the tightening usually reveals stresses that lead back to easing. The bigger picture is that we are in the late stage of a long-term debt cycle. Debt is high, deficits are large, and monetary policy is stretched. The Fed's tools are limited. They can change rates, they can buy or sell assets, they can expand or contract their balance sheet, but they cannot make the debt go away. And they cannot change the structural imbalances that exist. As a result, the trajectory points toward more currency debasement over time. That is the path of least resistance. Understanding this context allows you to see beyond daily price moves. Gold and silver are not just reacting to short-term news, they are reflecting the underlying reality that the monetary system is under pressure. The Fed can manage cycles, but it cannot escape the fundamental trade-offs. That's why their policy context matters so much, and why precious metals remain a critical piece of the puzzle. When you think about gold and silver, the most important driver isn't just inflation by itself. It's the relationship between inflation and interest rates, more specifically, real yields, what you actually earn on your money after adjusting for inflation. History makes this very clear. Whenever real yields are low or negative, gold and silver become far more attractive. That's because they don't pay interest or dividends. Their value comes from holding purchasing power over time. If holding cash or bonds yields less than inflation, then the so-called opportunity cost of owning metals disappears and capital naturally shifts toward them. The current environment shows us exactly this tension. Inflation has been running hotter than policymakers expected, and it's not confined to one or two sectors. It has shown up in energy, housing, and basic goods. The Fed responds by raising nominal interest rates, but the question isn't just how high those rates go. It's whether they exceed inflation. If inflation is at 5% and short-term yields are at 4%, the real yield is still negative, and that environment tends to push investors into gold and silver. Markets are forward-looking and they discount expectations. Investors believe inflation will persist while the Fed hesitates to raise rates aggressively. They prepare for a prolonged period of negative real yields. That dynamic often causes gold prices to rise sharply. Conversely, when the Fed manages to raise rates above inflation, creating positive real yields, gold usually struggles. You can see that in past cycles, such as in the early 1980s, when Paul Volcker raised real yields decisively into positive territory, which crushed inflation but also led to a bear market in gold. The tricky part today is that the amount of debt in the system makes it very difficult to repeat that kind of policy. Raising rates high enough to create consistently positive real yields would make debt servicing unbearable for households, corporations, and the government itself. That means there is a ceiling on how far the Fed can push, and investors know that is why gold continues to act as a hedge against the risk that inflation remains sticky while policy remains constrained. Another layer to consider is credibility. Inflation expectations are as much about trust as they are about statistics. If people stop believing that policymakers can maintain the value of money, they begin seeking assets outside the system. Precious metals play that role, so even in moments where real yields look positive on paper, if the underlying confidence in the system is shaky, gold and silver can still attract flows, so the essence of this is simple. Gold and silver are inversely tied to real yields, not just nominal rates, and the probability today is skewed toward real yields remaining low or negative over the long run because the cost of pushing the much higher are politically and economically difficult. That is why understanding this relationship is crucial and why metals retain such a strategic importance in portfolios. The story of debt and money creation is as old as empires themselves, and the patterns are remarkably consistent. Economies grow by expanding credit, which fuels consumption and investment. Over time, the debt burdens accumulate, and when they reach levels that can't be sustained by normal growth, central banks step in. They lower interest rates to ease the pressure. They inject liquidity, and eventually, when those tools are not enough, they expand the supply of money itself. Dynamic has repeated across centuries, and it always carries implications for the value of currencies and for the role of gold and silver. The United States today sits on a mountain of debt, government debt, corporate debt, household debt. The cost of servicing that debt rises whenever interest and rates rise, and that creates a structural problem. If the Fed keeps policy tight for too long, it risks triggering defaults, bankruptcies, and systemic stress. If it eases to relieve that pressure, it fuels inflation and undermines the currency. Either way, the system leans toward instability. That is why in practice, central banks almost always choose the path of monetary expansion because it's less immediately painful than forcing widespread defaults. But that choice steadily erodes the value of paper money. When more money is created than there is real productivity growth, the value of each unit of currency falls. You may not notice it day to day, but over years it becomes obvious. The purchasing power of the dollar declines. That decline shows up in higher prices for goods and services, and it shows up in the value of tangible assets. Gold and silver don't change. They are inert metals. What changes is the money they are priced in. When currency is debased, it takes more units of that currency to buy the same ounce of gold or silver. That's why metals are historically reliable as hedges against monetary expansion. Another layer to this is the international dimension. When one central bank expands aggressively, its currency tends to weaken relative to others. But when all major central banks do the same thing, as they often do during global downturns, then the debasement is broad-based. In those moments, gold becomes the neutral reserve asset. Central banks themselves understand this, why many of them hold significant gold reserves. It is no coincidence that central banks' facts have been net buyers of gold in recent years. Even as official policy often emphasizes fiat stability, they are diversifying against the very risk they help create. The long-term risk is clear debt levels that can never be repaid in real terms will eventually be managed through financial repression. Inflation or currency debasement, that is the path of least resistance for investors, makes gold and silver less of a speculative trade and more of a form of insurance. They are the assets that lie outside the cycle of promises and liabilities. Assets that maintain value when the currency itself becomes the problem. In a world of rising debt and accelerating money creation, their role becomes not optional but essential. One of the most overlooked but powerful forces shaping the gold market, it is what central banks themselves are doing. These institutions don't act on impulse. They operate with a long-term view of risk, stability, and national interest. When you see central banks buying gold, it's not a short-term trade. It's a signal about where they think the global financial system is heading. Over the last decade, and especially in recent years, the message has become clearer. The world's largest reserve managers are diversifying away from paper assets and into gold. Historically, central banks held gold because it anchored trust in their currencies. In the modern era, many shifted toward holding more U.S. Treasuries and other government bonds because those assets were liquid and generated yield. But as debt levels exploded and money creation accelerated, the calculus began to change. Holding too many dollar-denominated assets exposes central banks to the risks of U.S. policy decisions. If the U.S. runs large deficits, prints more money, or allows inflation to rise, those holding its paper assets pay the price. Gold doesn't carry that risk. It is no one's liability. That distinction matters enormously in times of uncertainty. Recent data shows central banks, particularly in emerging markets, increasing their gold reserves at the fastest pace in decades. China, India, Turkey, and Russia have all been significant buyers. These countries understand that the global order is shifting. Reliance on the dollar as the sole reserve currency creates vulnerability, especially in a world of geopolitical tensions and sanctions. By increasing gold holdings, they reduce their exposure to the dollar and signal to markets that they expect more turbulence in the global monetary system. The Federal Reserve, while not a net buyer in the same way, also recognizes gold's importance through the stability of its existing reserves. The United States continues to hold one of the largest official gold stockpiles in the world. The fact that those holdings remain untouched underscores their role as a last resort anchor of confidence. If gold were irrelevant, central banks wouldn't hold it. The reality is the opposite. They guard it carefully because it's the ultimate hedge against loss of trust in paper currencies. For individual investors, central bank action should not be ignored when the biggest players in the monetary system are signaling caution by buying gold. That is a cue worth paying attention to. These institutions have access to information, resources, and foresight that most individuals don't. If they see the need to diversify suggests that risks in the current system are greater than they appear on the surface, the broader implication is that gold is not just a commodity, it's a geopolitical and monetary asset. Demand is increasingly tied not just to inflation or interest rates, but to the trust or lack thereof in the financial system itself. Central bank behavior confirms that this trust is weakening, and when trust erodes at the institutional level, the role of gold and silver for individuals becomes even more important. When you think about positioning in gold and silver, it's important to step back and recognize what role they are meant to play in a portfolio. They are not about maximizing returns in the way equities or growth assets are. They are about balance, protection, and optionality in environments where traditional assets underperform. Strategic positioning means asking what are the risks I face if I'm concentrated in paper assets, and how much exposure to gold and silver would help offset those risks. The key principle here is diversification. A portfolio concentrated in stocks and bonds is essentially concentrated in the same bet that central banks will manage growth and inflation well enough to preserve both real returns and stability. History shows us that this assumption eventually breaks down. When inflation runs hot, bonds lose value. When monetary tightening follows, equities lose value. In those cycles, metals often move in the opposite direction, preserving purchasing power when other assets are eroding. That inverse relationship is what makes them powerful as diversifiers. The question then becomes how much to allocate. There's no single answer because it depends on your tolerance for risk, your income needs, and your view of the macro environment. But the logic is to hold enough that if things go badly, persistent inflation, currency debasement, or financial instability, you are not fully exposed. For many investors, that might mean 5–15% of their portfolio. For others, particularly in environments of heightened risk, it may mean more. The principle is not to swing for the fences, but to ensure balance. Another element of positioning is time horizon. Gold and silver are not trades you measure in weeks or months. They are assets you hold for years as insurance. That means you need to accept periods of volatility. Prices will rise and fall sharply, sometimes for reasons that seem disconnected from fundamentals. But the real value lies in holding through cycles. The protection they provide often appears suddenly when confidence in paper assets erodes. If you try to time those moves perfectly, you'll almost certainly miss them. Risk management also means understanding liquidity. In times of stress, you want assets that can be converted to cash if needed. Physical metals provide security, but they may not be as liquid as exchange-rated instruments. On the other hand, ETF and futures provide liquidity but carry counterparty risks. A thoughtful approach often combines both holding physical for long-term security and liquid instruments for tactical adjustments. Finally, positioning isn't static. The environment changes, and so should your balance. When central banks are tightening aggressively and real yields rise, it may make sense to reduce exposure temporarily. When easing resumes or when debt and deficits accelerate, increasing exposure may be appropriate. The discipline is in continually reassessing where we are in the cycle and making adjustments without abandoning the core principle that metals are insurance. In short, strategic positioning is about humility. It's recognizing that we can't predict every outcome, but we can prepare. Gold and silver provide resilience in a world where currencies and policies are uncertain. And in that sense, owning them isn't speculations, it's prudence. Here's what I want you to leave with. We are in a period where the probability of inflation staying elevated or of currency erosion is much higher than many believe. At the same time, central banks, especially the Fed, are walking a tightrope, balancing inflation control, economic growth of normalizing policy via risk of triggering a recession. If you own gold and silver, you are not just betting on metals. You are making a bet on these big forces: inflation trends, monetary policy, systemic trust, and right now the scales are tilting in favor of precious metals being a critical component of a diversified portfolio. So act with clarity, position with humility, respect the risks, but don't shy away from the opportunity.